Hey, real estate investors! Welcome back to the channel. If you're looking for ways to maximize your tax savings, you've come to the right place. Today, we're diving into a powerful strategy called cost segregation. It's a way to accelerate your depreciation deductions and save big on your taxes, especially in the early years of property ownership. Whether you're new to real estate or a seasoned investor, this video will give you the insights you need to make the most out of your investments. So, let's get started. First things first, what exactly is cost segregation? When you purchase a property, you typically pay one lump sum for the entire asset. But in reality, that property is made up of various components: the land, the building, and everything inside and around it, like appliances, carpeting, and even landscaping. Normally, you'd depreciate the building over 27.5 years if it's residential, or 39 years if it's commercial, using a method called straight-line depreciation. This is the slowest form of depreciation. But with cost segregation, you can break down the property into its individual components and depreciate some of them much faster. For example, personal property like appliances and carpeting can be depreciated over 5 to 7 years, while land improvements like landscaping and parking lots can be depreciated over 15 years. Now, you might be wondering, how does this save you money? By accelerating your depreciation deductions, you reduce your taxable income much faster in the early years of ownership. This means you pay less in taxes up front, freeing up cash for other investments. Let's say you bought a rental property for $120,000 and you determine the land value is $20,000, leaving you with $100,000 to depreciate. With regular depreciation, you deduct about $3,085 in the first year. But if you use cost segregation, you might identify $15,000 worth of personal property and land improvements that can be fully depreciated in the first year under bonus depreciation. That could boost your first-year deduction to over $17,000, a huge difference. Thanks to the Tax Cuts and Jobs Act, cost segregation became even more powerful with the introduction of 100% bonus depreciation, available from 2018 through 2022. This means you could deduct the full cost of personal property and land improvements in the first year. Even though this percentage is starting to phase out, down to 80% in 2023 and further in the following years, it's still a valuable tool. And don't forget about Section 179 expensing, which allows you to deduct the full cost of personal property up to a certain limit. In 2024, this limit is $122 million. Just keep in mind that Section 179 has both a dollar limit and a profit limit, so it's important to plan accordingly. Before you jump into cost segregation, it's important to be aware of some potential drawbacks. For one, if your accelerated depreciation creates a loss, you might not be able to deduct it right away due to the passive loss rules. These rules prevent you from deducting real estate losses against non-passive income, like your salary, unless you meet certain exceptions. Another thing to consider is depreciation recapture. When you sell the property, you'll need to pay back the depreciation you claimed at ordinary income tax rates. This can significantly reduce the tax benefits you gained if you sell the property within a few years. So when is the best time to perform a cost segregation study? Ideally, you want to do this in the same year you purchase, build, or remodel your property. This is when you'll likely spend the most money and can reap the greatest tax benefits. However, you can also perform a study later and make a catch-up deduction for the difference between what you've already depreciated and what you could have deducted with cost segregation.